Hello, everyone. Thank you for joining today's web conference, the CNR 2024 October Market Update. My name is Amber Ortiz, and I am a Senior Vice President and Team Lead at City National Bank. And I will be moderating today's presentation. I'm joined by key leaders from CNR's investment strategy team, including Chief Investment Officer Charles Luke, Senior Economist and Senior Portfolio Manager Paul Single, and Head of Fixed Income Mike Taylor. The views and estimates you will hear today are sourced from our investment committee's weekly meetings. During today's call, our presenters will share CNR's perspectives and what's in store on the economy, financial markets, and the effects on client portfolios. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar. So please type them into your console's Q&A window anytime during the session. You can also download the presentation materials using the resources window on the right side of your console. I'll now turn the call over to Charles Luke at City National Rockdale.
Great, thanks Amber, and welcome everybody. So there's certainly a lot to talk about with the election around the corner on Tuesday, and we certainly have some volatility in the data coming out. We've got the jobs number tomorrow, election Tuesday, and then some additional news from the Fed on Wednesday with what they're going to do with rates. So we wanted to level set first, just from an overview perspective, go through the agenda and what we're going to talk about today. So I'll talk about the speedometers, what we see from an economic outlook perspective, go through some of the numbers there. Then we're going to go pretty deep into the election policy impact. So we'll talk about the different potential outcomes from a Harris win or a Trump win. Then we'll talk about the market impact, so what we're seeing on a sector basis in some different areas around the market. And then Paul's going to get into economic fundamentals. Mike's going to take the bond market, and then I'll wrap us up with a little bit on the equity market. So definitely a full agenda. So to kick things off, as you know, our speedometers are released on a monthly basis, and this is pretty much the fundamental place that we start. So we're working through a lot of the changes that we'll have for October, and of course, prior to the election, we're in a little bit of a limbo. But a couple of things that I want to identify here. First is the monetary policy outlook. So the Fed was getting a lot of attention in September, probably not as much attention lately as we roll up on the election. But we do believe that that impulse from the Fed is going to be a key factor in the economy and for returns. So we know unequivocally over history, when the Fed is in a rate cut cycle, the market does tend to do very well. I also think the Fed's a big deal right now, and Paul may touch on this a little bit, but in a Trump win scenario, there is this conversation going around about the independence of the Fed. So we're very focused on that. It is being heavily debated. We do think it's a long shot, but it's certainly going to create some noise. The other area of our forecast that we've been particularly interested in and focused on has been our rate forecast. So you can see that in the top line with the yield curve and interest rates. And so overall, the rate environment, based on some of the potential outcomes here, has been trading much higher. So we went from a low of about 360 to where we are now around a 4.28% level on the 10-year US Treasury. And we've stayed very firm on our target for the 10-year. So we've been about 375 to 4.25. But overall, if we think rates stabilize there, we do think that that's a pretty good place for bond returns, as well as for economic activity. And then the other comment that I'll make on our speedometers now is around disposable personal income. So just how much money is essentially out there to be spent in the economy. Paul's going to roll through some of what we've seen in terms of economic revisions that have been very positive, but the consumer does look like it's in much better shape than even we expected. The other comments here is around aggregate price to earnings. So just the valuation, if you look at the bottom level on the equity market, we've got that in the red just based upon the aggregate, but we'll walk through some of the other price to earnings and relative valuations in other sectors. And we do think that there are some opportunities out there. So at the top level, we see the economy continuing to grow. We think there's a high potential for a soft landing. So that's a controlled slowdown, or a no landing where we continue to sort of pace the level of growth that we've seen. So if we go into our forecast to run through these quickly, we haven't made any significant changes since last month. Overall, GDP growth we expect to remain at a sustainable long-run level. So that's about 175 to 2.25 this year. It may come in a little bit higher than that. We did get GDP estimates for the third quarter yesterday that came in at about 2.8%. So very positive level there. But we do think somewhere longer term between that 1.5% and 2% level is the appropriate pace of growth. So again, we're probably a little bit low this year, and we may even see some revisions up, but we're going to be returning to that long run level. And then earnings we're going to dive into because Q3 has been a little underwhelming so far. And I think that's why you're seeing a little bit of the market reaction today across the board. But it certainly hasn't seemed to derail the market over the longer term. So I think what's created a vacuum is that companies are getting punished for missing estimates, although many are actually making their estimates, but guidance is changing. But we tend to see more volatility than regular in terms of how those moves are occurring as far as earnings. And then if we think about inflation, we do think the run rate is definitely falling, but policy outcomes do have the ability to, I think, arrest this downward trend that we've been seeing under both candidates. So I don't think it's just a Trump or Harris type of situation. Overall, deficits don't seem like they're a big part of the policy agenda, and we'll go through that. And then I touched briefly on the prior page with respect to Fed and the 10-year Treasury note. But the areas that we're sticking out here, we do think we're going to get 2 more cuts from the Fed this year. But we've stayed firm in our 2025 outlook that is showing the Fed at around 3.75 to 4.25. And based upon what they projected back in September, the market's actually priced out a lot of those potential rate cuts. So it's moved up by about 0.75% since that time, which is more in line with those estimates. So we continue to believe there's some structural pressure in the market that's going to stabilize rates at these levels. So moving right into the election, I think we all know that the race has tightened here significantly. There's definitely been a clear bounce for the Trump campaign since about October 7th. And just to run through some of those numbers, because they're highly differentiated depending upon what you're looking at. But if we start with some of the averages, Trump looks to be slightly ahead at this point from a polling perspective at about 0.4%. And that's a shift from a Harris advantage if we go back to just October 5th of about 2.1%. If we look at other polls, specifically more statistical based, and this is coming from a source called 538, Harris does remain in the lead on those polls with an advantage of about plus 1.4%. And then if we turn that and look at things like Polymarket and Predictit, that are these prediction markets that you keep hearing about, it has skewed heavily in the direction of Trump, especially on the Polymarket side. And then Predictit, which is a different place entirely, actually has it narrowing between Trump and Harris. So Trump there has about a 56% probability of a win versus Polymarket at about a 65%. And those have just been late surges. So there's still no clear definitive answer on what's going to happen on Tuesday. Things are extremely tight. Battleground states, particularly Michigan, Wisconsin, and Nevada, remain extremely close, and it's likely to come down to one of those. And then down ballot, it's also been interesting as well. So there's still a high percentage that the Senate probably goes Republican, but right now in the House, it's been a toss-up. So the reason I walked through that is I just want to stress, and we've been doing this now for quite some time, but I want to stress that the volatility chart that you're seeing here, that big spike up in volatility around the election, it doesn't last. It does come down. And returns to the market beyond the initial reaction do tend to do very well in the aggregate. So I think November and December are probably setting up for a very nice relief rally, and we tend to see that overall in market seasonality during election years. And I'm going to walk you through some of the advantages that we probably see candidate to candidate, but again, the race remains very close. And then just talking about markets, we've shown government control in the past, so we don't have that content here, but markets have gone up under different government controls and they have gone down. But what I want to do stress here is that when we look at different combinations, it does just so happen that the 2 combinations that have resulted in the highest returns are the 2 most likely outcomes. And so what those are is a Democratic president and a split Congress. On average, the market rises about 8.68, 8.7% annually. With the Republican sweep, the market tends to rise about 7.1% annually. And those are the 2 highest scenarios. So regardless of what the outcome is, I think, again, we're setting up for a positive advance. So our advice here is not to panic. We think there's going to be ample opportunities after the election to make changes based upon what happens. And I think trying to do that before the election does add huge risk to the portfolio overall. And so jumping into just a high level and starting with policy, I want to go through some of the impacts and effects, and then we can dive into which sectors the market may respond to under the candidate. So first, if we think about full policy implementation relative to plausible implementation, we've graphed that on the left-hand side. And so the key to remember here is that regardless of who has the presidency, there are going to be razor-thin majorities in the House and Senate. So it's not just going to be a situation where things are going to get passed regardless of the control. And so if you look at that left-hand side, we're looking at GDP and inflation. So under Harris, which is the first two columns, we do expect more of a continuation in current policy. And there is a difference with her platform right now in terms of tax credits, housing, and price controls. But I do think a lot of those are related to sort of campaign promises. We may not see the same translation if we are under a Harris win. But some of the policies still under Harris, on the platform are inflationary. And the main tax policy of increasing corporate taxes, we think, is unlikely to pass, really in either a Trump outcome or a Harris outcome, getting hikes or getting cuts. So to try to put our arms around what we'd expect under Harris, we do expect very little change in GDP, but modest pressure on inflation based upon the debt and deficits. Now, Trump, on the other hand, this is the third and fourth column. It's a very different scenario. So if we think about his corporate tax policy right now, the proposal is to be 15%, which would certainly be stimulative, but I think it's unlikely. And tariffs as well as immigration may be headwinds to growth, so there's a little bit of a balance there. But if Trump were to implement the current platform without any checks and balances, we do think there could be a significant increase in growth, but that comes with a caveat that we would see a potential jump in inflation and more pressure on interest rates. But under the plausible scenario, it's a little bit less impactful. So we'd see a smaller change to GDP, but policy-wise, there would still be some pressure on the inflation front. So in a nutshell, I think comparing the policy implications across both candidates, Trump's going to have a little bit of advantage over Harris on the growth front, but he's going to have a disadvantage versus Harris on the inflation front. So very, very different policy implementation. But I do want to stress as well, keep in mind the economy just grew at 2.8% in the third quarter. So there's nothing wrong with the fundamentals, and growth rates today remain very high relative to long-term expectations. So even if there's a full balance, regardless of which candidate is elected, we're still growing and the fundamentals are still very positive, what we would think is above potential. And so what I really want to dive into is the right-hand side. And this has picked up a lot of steam in some articles that we've seen and some other commentary. And we've actually been talking about the potential pressure that we could see on inflation, specifically from tariffs. But the overall debt level of the US is definitely a significant concern, and it's going to be impacted by both candidates. And it is a topic that I get asked about probably the most. So there's no doubt, if you look at the right-hand side, that debt to GDP is likely to go up under both candidates. Now, Harris may have a slight advantage here, just given the potential tax policy, but both candidates are not going to cut deficits. And so the smartest way that I've seen this addressed lately is to use ratios of spending and debt and deficits to GDP. So right now, the long-run debt to GDP is about 21%. Today, it's about 24%. So that sort of level sets everything a little bit. And then to put it in context, the US government has always run deficits going all the way back to 1945. Now, they flip between deficits and surpluses, and at times they've been under more control. And again, they have switched to surpluses temporarily. But I think looking at that has two implications. The first is that debt has increased over time in terms of the deficit, but the stock market has annualized since 1944 at about 11.5%. The second thing that I would stress is there is a pathway out of this. So if we look at from 1970 to 1995, deficits were run at the same level based on GDP as they are today, and they were run for a little bit longer. And then from 1995 to 2002, those deficits were erased and we swung into surpluses. So it certainly can be done. It is going to take political will. I do think voters are going to have to step up to the plate on that, but I don't think all is lost. And I don't think we're going to end up in a hyperinflationary scenario like we've been seeing and like's been discussed out there. We also think the idea that the US dollar that's going to be unseated anytime soon just doesn't add up with the trajectory we've seen. So, in this risky geopolitical environment, the dollar has remained strong and US rates are still elevated above global rates. So we're not seeing a major impact to the dollar. So I think the bottom line for dollar dominance here is that it's associated with stability, rule of law, and growth. We still have those things, but we've got to maintain that in order to help with the deficits and to get us back on the right track. Now I'd like to move into taxes and then talk a little bit about tariffs as well. But what you're looking at here, this is the individual tax level. So all the way from incomes around 0 to 28,000 to about 915,000 and above. So at each individual tax level, if we isolate the policies of each candidate, under both outcomes, household income is actually likely to rise. Now, where it differs between the candidates is that with Harris, you have a slightly higher bump up for lower income individual tax rates. And then you have a bigger decline in the 915,000 and above. And so we've seen that through a couple of different policies and what could potentially be implemented there. Now, the major concerns that we have with Harris policy, and again, I get this question a lot, but it relates to unrealized gains. So if we put the probability on that being implemented, taxes on those unrealized gains, we have it at about less than 10%, so we don't think it's a high outcome. And the reason for that is that other countries have tried this in the past and it hasn't worked. So high income earners have found ways to shelter capital gains. And then further, I think it's a red line for Republicans. So it would be very difficult to get this through Congress and ultimately into law. And then the last thing, which I don't think any candidate wants to do, is it's absolutely going to hurt market returns if it were implemented. So it's a situation where if the market goes up, you pay taxes. If the market goes down, there's no offset. So really the incentive here is why invest in risky assets if you're going to have to pay those taxes. So for those reasons, I don't think that's plausible. But the main thrust of this chart here is that we're going to see a change in income taxes to go down a little bit and to increase that income level across the board. And then if we take that one step further and then start to add in the impact of the tariffs, and I know it's going to sound a little bit like I'm picking on Trump here, but this is just if he was able to get everything done, what's going to happen. But if we focus a little bit more on that, we isolated tax policy in the first slide. So on the left-hand slide here, what we're showing is that if you add tariffs in, it's going to be a significant drag across the board for all income levels. So if you get those taxes that are implemented fully, we're going to see real income declines across the board, and it actually would impact those low income earners the most. And that's not much different than what we're experiencing today coming out of COVID. We know that inflation at about a 27 to 28% cumulative run rate, it does hurt the most for low income earners. And so the result of this is it may not impact the broader economy and stock returns, but I think we have to be concerned at a lower level in terms of what that impact could be. And then under all styles of Trump tariffs, if you look at the right-hand side, the effective rate is likely to increase anywhere between 6.3% to about 10%. So I don't think we can make any mistake about it. Tariffs are probably the easiest thing to implement out of all the policies that we're seeing out there. And upon taking office, if it does occur for Trump, I think it's one of the things that could get underway very quickly. So Trump is very serious about tariffs. If they do get implemented in a big way here, I think it's going to be a little bit harder to fund the deficit. It's going to put some pressure on inflation. I do think rates are going to stay in this level a little bit higher for longer. And I do think there's a little bit of an increased risk of government debt crowding out other areas of spending. But there are offsets to Trump's policies. And if we can continue to stimulate growth, the problems do become a little bit easier to deal with. But certainly if they don't, we could see some trouble in the bond market and some interest rate sensitive areas of the broader equity market. And so moving into corporate taxes, here's a categorization of just what's on the table. So if we look at the left-hand side, you can see the current top rates about 21%. Harris's proposal is around 28, and then the Trump proposal is around 15%. But let's go through a quick scenario here. So the effective rate right now for corporations is about 18% under the current tax level. And so if we start with Harris, if we get that full 28% implemented, the effective rate should shift up to about 25%. And that could chop off about $16 from S&P 500 earnings. So that implies about an 8.6% impact on overall corporate profits, call it 9%. So that's a drag overall in corporate earnings. Now under Trump, let's assume that he cuts the rate on domestic profits, so this is made in America, by about 6% to 15%. And he cuts the rate on foreign operations at just a 1% level. So what that does is tax rates drop from the 18% type of level we're at now to about 14%. And then under this scenario, we think S&P 500 earnings could increase about $10. That results in a broad profit increase of about 4.7%. So the impact of moving to 28 is a little bit steeper than what we'd see for Trump cutting to 15. But if we look at it, generally, S&P 500 returns have been positive after years where we do get tax hikes, but they've been anemic. So think around 2 to 4%. So what that means for sectors is we've got to look at who the largest beneficiaries were when we had the 2016 tax cuts under Trump. So that's the TCJA, the Tax Cuts and Jobs Act. If we look at that, the biggest beneficiaries there were utilities, consumer discretionary stocks, consumer staples, and industrials. It was less of an advantage for financials, healthcare, and technology. So if we see the increase up to 28%, the likely outcome under Harris would be headwinds for those sectors that benefited in 2016. So that's mostly defensive sectors. And there's muted effects on the growth-oriented cyclical areas of the market, like I mentioned, healthcare and technology. Under Trump, generally, what that means is that defensive sectors could benefit. And if we look back in July after the debate with Biden, the best performers for him, or based on that outcome, was real estate, financials, utilities, and materials. But more companies that do derive their profits globally under Trump, I think, could be at risk a little bit. And those top three sectors that could potentially be exposed would be healthcare, technology, and energy. And I do want to touch on immigration quickly because it is an important part about this debate. And I'm going to focus on the actual policy impact and what could happen from a growth and inflation standpoint. So it's definitely going to have an impact, but I don't think it may be what we think. So there's a lot of commentary out there that I hear it's going to be inflationary because of the cost that would basically increase for employment and the cost of labor. But if you think about 20 million people, if the full deportation was to come into effect from Trump, it serves as a major offset to growth and inflation. So again, we think that drag, if you go all the way to the right side here on the graph, could be about 8% by 2028 to GDP, and could pull inflation down by about 1.6%. Now, it's certainly not as pronounced if you get a seal the border type of approach, or if you kind of deport the unauthorized immigrants in the country now. But regardless of the scenario, it still is somewhat of an offset to what we might get, again, in a Trump win, if that were to occur. It's an offset to some of those more inflationary policies. So we really don't know how these are going to interact, but I do think that there could be some counterbalancing that could occur. And under Harris for immigration policy, as I did mention before, we could see a continuation of current policy, but I do think that it's probably going to have a muted impact on growth and inflation. And so what we wanted to do from a policy perspective was to give you kind of an easy cheat sheet. And so what we did was we went through the different policy changes. So taxes, tariffs, debt and deficits, and immigration. And then we looked at key components of the economy. So GDP, inflation, interest rates, and corporate profits. And so if you think about the impact of lower tax rates, across the board, we're likely to see a bump up in each one of those economic characteristics. If you think about higher tariffs in that vein, GDP will probably be lower. Inflation is likely to be higher. Interest rates are likely to have that structural pressure. And corporate profits, despite maybe benefiting some domestically based companies, are likely to be a little bit lower. If we look at debt and deficits, the impact to GDP right now is probably neutral, just given the impact that we've seen as deficits have grown. If we look at inflation, it's definitely a higher impact. And so we might sort of stabilize here at these levels, potentially move back to 3% based on the outcomes and the policy implementations we get. And then the impact on interest rates is likely to be a little bit higher. And I know Mike's going to talk about this too, but I just want to stress that we think that this range of 3.75 to 4.25 and where we are currently is an area where rates can stabilize. We don't see a scenario where you're going to get this hyperinflationary environment that's going to push rates up, beyond levels we can even kind of comprehend now. And then as far as debt and corporate profits, again, relatively neutral. Corporate profits have grown under deficits, and the market has done very well, as we know, as deficits have increased. And then finally, with immigration on GDP, that drag from demand coming out of the market is likely to be a lower impact there. On inflation, likely to be neutral. Interest rates a little bit lower, pulling it down, and then corporate profits a little bit lower. So that's a cheat sheet that everybody can use over the next couple of days. And so those are all the policy implementations. So now I want to go a little bit into the market. So let me explain this graph quickly. What you're looking at here in the blue is a trade basket associated with some of the sectors that we believe could do well under a Democratic win, under a Harris win. Now the red is a Republican trade basket. So those are the stocks and sectors that could do well under a Trump win. And then the green line here is the S&P 500. So if you look at the Republican trade basket in red, there has been a recent surge relative to the Democratic stock basket, and that I think does underscore the tightening of the race. But if you look at the Democratic basket overall, it has increased more over the past year, but it has been more volatile. And a lot of that is the exposure to some of the riskier companies that you see in the renewable energy sector. But again, it has done well over the past year. So what this indicates to us in terms of sectors that could potentially do well immediately would be a Democratic win could favor industrials. And by these types of industrials, I mean energy infrastructure, government contracting. We also think Harris could likely benefit healthcare, certainly renewable utilities, and some consumer discretionary sectors. Now, under Trump, I think it's clear, financials have done very well since the beginning of October. We did get a great earnings season for financials to kick us off. But we also think US focused industrials, so these would be more defense and aerospace. And then we do think energy and materials also may benefit if Trump were to win. But what I want to underscore here as well is generally, and based on past patterns, Harris might be slightly better for cyclical growth-oriented sectors and companies. Trump may skew more value. But what tends to happen after the election is that leadership does become cyclical across the board. So it's common to see leadership be more defensive in the roll up to November, and then it's common to see that flip after election. And that cyclical tendency does persist for about 6 months, and growth does tend to do well. So that's good news for Harris, but it also means that under Trump, some of the past patterns and behavior of the market all will not be lost for growthier sectors of the market, and specifically tech, I think, under a Trump win. So as we move through this election commentary, what I want to do is encourage everybody to anchor on the following facts over the next couple of days. The first is that the stock market is not partisan. The second is that when we look at November and December of election years, they've shown over time to be great performance months overall. The third thing, the economy is in great shape, and you're just about to hear that from Paul. And then the fourth thing is that corporate earnings do continue to advance. So they're in a very good place here at very high levels. So the fundamentals are strong, and we do think that based on getting through this uncertainty and having a result, that through the end of the year, we've got some tailwinds in the market. But there are just a few more things that I want to touch on, and these are beyond the election, but I think they're important. So the first area that I want to talk about is what's been happening with gold. So at a very general level, our belief is that the historical patterns for gold have been broken a little bit. So if we think about when it's done well in the past, all else equal, it tends to rally during periods of rising inflation, not falling inflation. So the rise this year there with respect to that is a little bit perplexing. And then gold also tends to fall in high rate environments. And we don't believe that we're in we don't believe we're in a lower interest rate environment. So gold tends to rally when we go into a lower rate environment. So we don't believe that's the environment that we're entering into, especially for longer term interest rates. So it has some behavior here that's a little bit different from what we would typically see. And I think it's also important to understand that gold has been sort of the only precious metal commodity that's really done very well in the full commodity complex. Otherwise, it's been a pretty bad year on a relative basis. So I think there are a couple of reasons why gold is rising here. First, we have the safe haven risk. Second, we've got easing Fed policy. And then we do have this concept of central bank demand, especially from China, as those reserves get built out a little bit in gold. So there's been some demand here. And then, of course, on the momentum trade, there is some speculation baked into the market. But what I'm really looking at is what's happening with the dollar. And there's no clear downtrend that's been consistent there. And so if we think rates are going to be higher for longer, I do believe there are some pretty high risks to holding gold in the portfolio at this point. So we think it's a little bit ripe for a potential turn. We're watching it very closely, but we think this run-up is a little bit overdone. The second concept I wanted to move through was talking a little bit about China, because this has really been an allocator's worst nightmare to see the type of stimulus that we got, and then those markets pop nearly 30%. But if you look at this chart on the right-hand side, at prior policy stimulus, it hasn't done anything to stop what's happening in the Chinese economy, which has been very poor performance. It's really failed to reinvigorate the Chinese economy with these past processes. So we were very early on to identify some of the risks to the economy in the property sector for China. And I think the best way to think about that is that this is the Chinese 2008. So this is their housing bubble pop. And we did exit that EM trade years ago. And then if you look at savings rates in China, which are up, so that's going to bring spending out of the environment. And then the most recent report on industrial profits, they fell by about 28%. So China-based corporations are not doing that well. And so I think these measures that we saw here recently did prop up stocks for a short time in China, but they came crashing back down. And so China right now, based on the volatility and what we're seeing in the underlying economy, is just not a place that we want to be investing. And then the last comment I'll make is we've heard a lot about the rotation, we've heard a lot about US markets and global markets. And earlier in the year, we thought that things were setting up for global markets and international investments to look a little bit better. We had growth bottoming and rising. We had a global central bank easing cycle that was underway. But if you look at actually what's happened over the year, let's just take Europe relative to the S&P 500. This is all the way on the left-hand side. That's basically pulled even with the U.S. market back in April, and it's only fallen since on a relative basis, almost 11%. We're seeing the same sort of behavior in EM. We did get emerging markets. We got this instantaneous pop when you had the influence from China. But since the beginning of the year, it's down 8.2% on a relative basis to the US. And then we can see China specifically spiking dramatically there on a relative basis, but returning to earth very quickly and settling in around market performer neutral to US markets. So we still very much feel that the US markets are the best place to be, especially with the level of uncertainty that we're rolling up on. So to summarize everything, and then I'll pass it off to Paul, we do think the underlying fundamentals do remain very strong in the economy overall. And then the policy impacts from the election next week are going to have four main areas. That's going to be taxes, tariffs, debt, and immigration. And so if we broadly summarize our conversation around Harris, we do think there will be a continuation of a lot of the existing policies, and that favors mostly clean energy. We think there will be more strategic tariffs, and that may benefit exporters under Harris. And then higher potential taxes do have the ability to hurt CapEx heavy sectors. So again, those defensive sectors we think will do better under Trump. For Trump policy, we think those changes, if he were to win, do favor financials and energy. We think domestic profits definitely could favor areas like utilities and real estate. And then trade and tax policy could lead to higher inflation and interest rates, but the policies also may increase the level of growth. And then we think both platforms are likely to increase government debt, but I do want to stress here that there is a pathway out. And then with gold and commodities, generally, commodities have performed poorly. Gold has climbed due primarily to geopolitical risk, but we do think that it's at risk because we think its near-term behavior has decoupled from a lot of the historical moves. And then overall, we think the US does remain the best market. So I'm going to stop there, look forward to your questions. I'll pass it to Paul, and then I'll circle back on the equity markets in just a bit.
That's great. Thank you so much, Charles. There's a lot of really important insight there that I think will help out an awful lot of people in terms of understanding what's going on in the world. In terms of the economy, it continues to outperform. I think today's Wall Street Journal article, the lead economic article, said it best in the headline, that whoever wins the White House will inherit a great economy. The U.S. economy is doing much better than its peers. In the past year, GDP growth has been around 3%. When you compare that against other developed nations, the top six, all their growth is under 1%. More importantly, what's creating the growth is its productivity improvements. It's not the fact that we just have more people working. That, of course, helps drive economic growth. But big increases in productivity has created about 2/3 of the gain in output or in GDP, whereas Europe, it's almost all based on labor. What makes this important for the economy is the fact that we're going to deal with an awful lot of issues over the next few years, and that's going to add volatility. But the fact that we have a higher level of productivity will allow us to absorb certain things like maybe higher prices that we may see because of geopolitical risks continuing to remain high. And that will allow economic growth to continue to move forward. The reason why productivity is so much higher in the United States compared to the rest of the world is really our acceptance of technology in the workplace. And with AI on the horizon, that just may add to it very much. For those that are old enough and remember life before the spreadsheet, it was a much different world when something just as simple as a spreadsheet created a great deal of efficiencies. And software, as you know, continues to get better and better, makes us more effective in our jobs. So the outlook looks quite good. Now, this does come to a surprise to probably an awful lot of people because the polls don't say that. Now, about 2/3 of Americans, according to a Wall Street Journal poll, say the economy is not doing well or it's doing poorly. But when you read into the details of that, what you find is they all think their own position is fine. They just worry about the broader economy. But the irony here is that if everyone's own financial situation is doing well, then guess what? The whole country's doing well. And that's why we see the economy chug along with a strong pace of growth, and we see big corporate profits. But in terms of how people feel, it's still very, very important. Of course, it's become a very important political issue this year. But the thing is what they say is that the biggest issue their concern is inflation. because they think that if inflation is bad, then the economy must be performing poorly. Now, we know that the Fed and financial markets look at the year-over-year change in prices and see that it's drifting down to a level that's highly acceptable. But for most people, they look at the absolute change and they say, well, food prices are 25% higher. And they're right with that. But inflation hurt in 21 and 22 when it was higher than income was. But in 23 and 24, income has surpassed the rate of inflation. And overall, people on average are earning more than the prices have moved up. So economically, they're much better off. But that doesn't change things. It takes a while to get accustomed to higher prices. It's that Kubler-Ross sort of thing. You have to go through different stages. But we do. People have long stopped complaining about gasoline being at $1 a gallon or $2 a gallon or $3 a gallon. You get accustomed to it, and as a result, things move on. But overall, the economy continues to do very well. We see that in the GDP numbers. We see that in corporate profitability. And of course, we see that in the financial markets. So let's take a look at some of the charts that we have here. First of all, the revisions to some of the data is showing a much stronger pace of economic growth. The chart on the left just shows the comparison of what GDP was before the annual revisions that were done at the end of September compared to what it was beforehand. And as you can see, the dark blue is what the new one is. And the percentage change is about 1.5 percentage points higher than what it was beforehand. And that's pretty darn important in terms of taking a look at the overall economy. What makes this even more impressive is the chart on the right. This is showing the dollar value of GDP, and it's just comparing it to what the trend line was before the pandemic, the 5-year period. Despite the fact that we had the most severe economic downturn since the Great Depression, we bounced back from that, and we're now on a trajectory that's steeper than what the economy was beforehand, a complete recovery. It's due to big actions by both the Fed and the federal government. And again, the issues that I mentioned in terms of productivity gains. This is what's driving economic growth overall. But in terms of a more relatable issue is these charts here. Now, again, these revisions happen every year, and it's based on new information that they get in terms of being able to judge what's going on. The chart on the left, I think, is probably the most important in the aspect that this is taking a look at people's income, the estimate of how much people earn on a year-over-year basis. In terms of a 12-month annualized basis. And as you can see, it adjusted upward. Most importantly is the data that we chose here. This is after-tax income and adjusted for inflation. So it's the truest measure of what people can do and they can't do. And as you can see here, that has increased by about $600 billion. That's an awful lot of extra money to have around. The chart on the right is the savings rate. And you can see that too has moved up because people didn't spend all that money that they had. They have more savings. And this one is not adjusted for inflation. They don't do that for the savings rate. But the issue here is that people have more money than we previously thought, and they've had more money socked away in savings. So this is very important for the financial picture of consumers going forward. And to me, the most obvious way of taking a look at how well off Americans are is what are they going to do with their discretionary spending. This chart here is from the Conference Board, and you can see how many are planning a trip overseas in the next 6 months. You can see how it's moved up so much. Now, nobody needs a vacation like this, but this is something that people are able to do and afford because they have the wherewithal to do so. Again, a sign that the economy is doing quite well despite what the polls say. And actually, I'm sorry, let me back up one more on this. To show how strong the economy is in terms of how well the consumer is doing. Now, the GDP report came out yesterday, up 2.7%. 2.5 percentage points of that was consumption. The other 0.2% was the other three components of investment, government, and net trade. The consumer is the driving force of this economy, and it is so because people have the comfort and the outlook on the economy, and they have the wealth to be able to drive that sort of thing. Now, what's going on with the data that's been coming out of late? The chart on the left is an interesting one. It comes from Citibank, and what they do is they just measure, did the report come out stronger than what was expected, or did it come out weaker than expected? If it's a positive number, that means it came out stronger. If it's a negative number, it's been coming out weaker. And as you can see, that since July, the data has been coming out much stronger than what the expectations were. On the right-hand side, this is from the San Francisco Fed, and they survey a group of newspapers, and they look at the articles. They have computers that do this, and is the article on the bullish side or the bearish side in terms of economic releases. And as you can see, for just about a year now, they've consistently been stronger in showing that the economy is doing better, at least what the news is. Now, this is a number we on the investment group follow very, very closely in terms of the stimulus that's in the economy. This is from the Chicago Fed in terms of financial conditions. Now, most people, when they think of financial conditions, they think of what's the Fed doing with short-term interest rates, because those drive pretty much all interest rates. And it is the most powerful tool in terms of stimulating growth or trying to restrict growth. But there are other issues that are going on at the same time. What are credit spreads doing? Are they widening or are they tightening? Is the yield curve steepening or is it flattening in terms of issuance of debt? They also take a look at things with the issuance of equities, the issuance of debt, what mortgage spreads are like, so on and so forth. They look at more than 100 different measurements, and they come up, are they getting tighter or are they getting easier? If it's below zero, that means it's getting easier. What's interesting is if you look, and this is a long-term view, if you look at the right-hand side of the left chart, you can see that conditions have gotten easier once the Fed started raising interest rates. And this is because of all the other factors that are helping out the economy. I mean, it's much easier to issue stock when the stock market is moving up, so on and so forth. The right-hand side just shows it in a little bit more detail in terms of the key factors, what's driving it. And this is just really important, is the fact that all these factors that they're looking at are helping to make financial conditions in the United States a whole lot better for further economic growth. Now, small businesses are important. They are the ones that do most of the hiring. It's about 80% of the hiring. It comes from small businesses, and that we define as businesses that are under 500 employees or more. So it's important to understand what they're thinking. Small business owners, they do tend to be a little bit more conservative than the average population, and that, of course, makes sense because they have an awful lot of responsibility. This chart here just measures the uncertainty, and you can see on the left chart to the right side, it's quite high right now. The green lines are when presidential elections happen. And these circles just make it a little bit easier to see. And you can see it tends to spike around the time of these presidential elections. Interestingly, the spikes tend to be more severe in the last few presidential elections than they used to be, but that's just part of how the population has changed in terms of far more partisan oriented. But the most important thing here is the fact that those come down afterwards. Once you get some sort of certainty, things move on. And as we know, year in and year out, the economy continues to do well, depending on, it doesn't matter who's in the office. But inflation still continues to be the number one concern. And you can see that here on the right-hand side. It's just not individuals, but these are the issues that I just talked about before. Businesses are worried about higher labor costs, and they're also higher about costs for their products that they come in that they then need to turn around and sell or need to use to produce whatever they're doing. But it's still high, and it's still high for the very same reasons that I said. People still relate to what it used to be, not compared to the year-over-year change. But probably the most important thing for an awful lot of these small businesses is the cost of labor, and that we see a lot of good news. A lot of it has to do with the fact that the economy is in the later stage of this business expansion. The light blue line that you see on the left-hand side is the hiring plans of small businesses, and that is trending downward. They're fully staffed, and they're pretty happy with what's going on. They're still hiring, but not at the pace that they had been beforehand. The interesting thing is the dark blue line, which comes from the Atlanta Fed, and this is considered one of the better measurements in terms of following wages. That too is also coming down, and that's an important thing. If you look at the right-hand side, it gives you the reasonings why they were high and why they're coming down. They were high, the light blue line, and that was people that were switching jobs a few years ago when the demand was so extreme when the economy opened up. But that demand isn't there anymore. So businesses don't have to pay up for a new employee. In fact is, what you see is job switchers, their pay increase is about the same as everybody else's, which is different than the history. Look at the history before the pandemic. Job switchers did tend to get paid more. That's not the case right now. Because we're seeing a softening in the demand for labor, wages are not as strong. And this is a big part in terms of what the Fed's trying to do in terms of having confidence that inflation will move down to 2% sustainably at that level for a long period of time. So to us, this is very helpful in terms of what the Fed is trying to accomplish going forward. So overall, the economy continues to do well, driven by the fact that the entrepreneurship and the attitude that many business people have in terms of economic growth is extremely strong. Payroll growth, although not as strong as what we've seen in the past, will continue to be a driving force, but the productivity gains will be very, very important. And all of this will help keep the economy on an upward trajectory and allow the Fed to continue to lower interest rates. So with that, let me turn it over to Mike to give us an update in terms of what's happening in the fixed income markets. So Mike?
Great. Thank you very much, Paul. So I'm going to start today with a little bit on the Fed and what we've seen rates do. So if you recall, in September, the FOMC surprised the market with a larger than expected 50 basis point cut in rates. And the bars on the left here show that, at the time of that meeting, they projected another 50 basis points this year, 100 basis points more next year, for a total of about 2% until they reach the neutral rate. If we look at the light blue line on this chart, what we can really see is that market participants, they initially took this larger than expected rate cut, to mean that the Fed might, be a little bit concerned about future growth. And so the market started pricing in a much more aggressive path to Fed cuts, going out through next year. But what you can see with the dark blue line here is that since that Fed meeting, and as Charles and Paul have been discussing, the economic data has been extremely positive, and so the market has really changed course, and it's now more closely aligned with the Fed. If we look at the chart on the right, I think what's really interesting here is what the yield curve has done. So since that Fed meeting, you can see the light blue line and the dark blue line. The light blue line is where the curve was at the time of the Fed meeting. The dark blue line is where rates were about a week ago, and we're somewhere in that range again today. And you can see that rates are up sharply across the curves, whether it's the short end or the long end. Yields are up about 50 to 60 basis points across the curve. And so here again, it's this strong economic data that's really helped change the narrative, and it's one of those factors that's been pushing rates higher over the last month. But what we're also seeing is the curve adjusting to or pricing in uncertainty around a number of different forces as well. And so the chart on the left here shows one of those forces that we see pressuring long-term rates, and that's Treasury issuance. And so with the election approaching, the federal deficit has come into focus again, and it is set to widen no matter who wins, and effectively this is going to drive the need for more issuance. And so, while supply might not be increasing, through the remainder of this year, it's likely to pick up next year. And with about 35 trillion in debt outstanding, the market's going to need to absorb this supply, and ultimately we think this is going to keep pressure on longer term yields. And then this increased volatility that we're seeing in the Treasury market, it's reflected in the chart on the right. And this is the MOVE index. And so, the MOVE index is much like the VIX index is for stocks. It tracks volatility across the entire yield curve, and it gives us some insight into the bond market. And you'll notice that, it'll be relatively range bound when markets are calm, but you can see it spiked during the pandemic. It trended upwards as the Fed was raising rates. We saw another little bit of a spike during the banking crisis last year. And what we're seeing in the very far right is that it jumped again in October. And so this spike, it's the market pricing in that period around the election. And so, we tend to see volatility increase during elections as a sort of event risk gets priced in. But when we look at the spike that we're seeing this time, it does appear to be a little bit larger than what we've seen in the past. And so the volatility that we're seeing here, it's reinforcing the idea that the market is digesting the implications of a strong economy on the back of that 50 basis point rate cut and an election that has the potential for larger deficits and an inflationary impulse that could come from tariffs. And so if we turn our attention for a moment to credit quality, so despite this market volatility, and seeing borrowing costs that are near multi-decade highs, we are seeing in corporations that are still able to easily service their debt. And so one measure of corporate health that we look at is interest coverage, or how many times operating income can cover interest expense. And so the chart on the left shows interest coverage ratios that remain above longer term averages. And we're also seeing that leverage is down from those pre-pandemic highs, and high yield companies in particular have done an excellent job refinancing debt and pushing these liabilities out into future years. And because of the turmoil during the pandemic, fiscal responsibility and balance sheet health has been a core focus. So as a result, if we look at the chart on the right, we see that while defaults have ticked up a little bit recently, we see activity normalizing with longer term trends. And the market has rewarded the health of corporations with tight spreads and strong demand in a year of what has been really strong issuance. And so when we think about volatility in the bond markets, and I think this chart is really important because it's important to look at how returns and the various components of that return. So on this page, we're deconstructing the return of the high yield corporate bond market over the last 5 years. And so the light blue line represents the price return. That steady upward sloping yellow line is your income return. And then the dark blue line is your total return, or your price plus income. And so what we'll notice is that while price returns can be volatile, it's that steady stream of income that's going to be your primary source of return over longer periods of time. So when we think about the high levels of income that we're seeing in the market today, not only does this offer attractive cash flows, but the income stream is going to cushion portfolios against price declines, and it's going to enhance return prospects through the compounding of income over time. And then finally, we take a look here at yields across the curve. So whether it's short-term, intermediate term, or high yield, this backup in rates that we've seen over the last month or so, we do think it's attractive. As Charles had mentioned, we do expect rates to be pressured in the long end of the curve, but we do see them at relatively fair value today. So whether you're interested in the front end of the curve or more intermediate term maturities, we do see yields being very attractive today. And just a reminder that a 3% muni yield, it equals a 5% taxable equivalent yield for an investor that's in a high tax bracket. So that means that you would need to find a taxable bond above 5% to equal that municipal yield. So yields do remain compelling for investors in high tax brackets and especially high tax states. And then to summarize, the FOMC easing, it's been met with sharply higher yields. Economic and political forces are going to continue to pressure long-term yields, but we expect credit fundamentals overall to remain healthy. And while the market may remain volatile, the high levels of income that are available in the market today are likely to cushion your portfolio and some of this volatility and will drive returns over the long term. And so with that, I'll turn it to you, Charles.
Great, thanks, Mike. So we'll wrap it up here with a couple of comments around the equity market, and then I think we can get in a question or two. So the first component that I just wanted to address in the equity market, and this goes back to some of my comments around Fed cut cycles, but what we've done here is we've graphed the historical average before and then after Fed cuts. So we've had a pretty unique experience here where the market has been running prior to that first rate cut, but we've had pretty similar behavior relative to past experience overall since that cut in September. So we do think that's going to be one of the biggest elements that's driving the market forward and giving us a good tailwind here. I also wanted to address a little bit about this market rotation. So we hear a lot about how, well, small caps are running or dividend stocks are running or growth and value, but we wanted to put it in context and just show you what's actually happened. And if you start with the first graph, this is growth versus value. So when this chart moves higher, it means growth is outperforming value. So we had that interim summer sort of spike in value stocks. And again, that was related to a lot of the potential candidate turmoil, the Trump-Biden debate, and other things. So we saw that big spike, but growth has sort of resumed its position over value as we've gotten into the end of the year here. Same thing with small caps. So if you look at the second graph, this is the top 50 largest stocks in the Russell versus the bottom 2,000 in the Russell. So you can see that going back to the beginning of the year, you had a pretty steady rise, you had that summer pop, and then those large cap names have actually resumed their outperformance relative to small caps. And then finally, looking at the S&P 500, the broader market cap weighted index and dividend stocks have been very good complementary asset classes so far this year, or stocks positions this year. But again, we see the broader market cap weighted index actually outperforming as we got into August. So I think the rotation is real in certain aspects, but I think it's failed to actually sustain itself. But the point is that it doesn't stop the market from broadening out. So one of the biggest things coming out of Q2 earnings was the fact that we saw positive growth for all other sectors of the market outside of tech for the first time in about 5 quarters. And then if we look at the year-to-date returns, starting with utilities at the top, and some of that is the artificial intelligence trade influencing power demand, but it's the best performing sector, followed by financials. So you do have some outperformance relative to tech, and then other areas of the market have participated as well. So one of the keys for us earlier in the year was we think the market can continue to move higher if we see a broadening overall in earnings and a broadening overall in performance, and we've definitely seen that. And then I alluded to this earlier in my comments, I think around the speedometers, but it's this wide variation in valuation. So if we look at the price to earnings ratio evaluation metric for information technology, so these are the main tech stocks, it's at 29.5. And that's about 35% of the market when you throw in some of the communication services names as well. And that's really balanced. That's really kind of putting the PE at a higher level. There are other sectors that are much more fairly valued, and that's helped buoy the market when we've seen these sort of sell-offs. So even in an environment like today, we're actually in a situation where utilities, energy, and consumer staples are running, and they're in positive territory, as tech and some of the more sensitive sectors are actually down. So there's been a good balance in the market. And then finally, I just wanted to give everybody a little bit of an update on Q3 earnings. So I think one of the reasons that we're selling off a little bit today is that we did have some major reports from Microsoft and Meta that actually did beat, but what people are concerned about is the forward guidance. So the capital expenditures and other areas around profitability has come down. So tech is having a little bit of trouble today. We're going to get some more earnings results from Apple and Amazon once we get through the week. But generally, about 75% of companies continue to beat. That's down a little bit from Q2 and Q1, but it's generally still been a relatively positive season. And the overall economic surprise percentage has been around 6%, which is in line with historical averages. So we still think corporate earnings here are pretty strong, and we've got another big week next week that'll tell us a little bit more about that. So I'm going to stop there, and I will pass it back to Amber for Q&A.
Great, thank you, Charles. It looks like we might have enough time for just one question. So Charles, I'm going to come back to you. You've highlighted several points related to the election and those effects on the market. Outside of the election, what are the key factors driving market volatility?
Yeah, so I mean, I think the biggest elephant in the room here, Amber, is what's happening with the potential involvement of the U.S. overseas, right? I mean, it seems like low-hanging fruit as a risk factor, and we've been talking about it since the Russia and Ukraine invasion, but it's still out there. It's still a major risk overall. So we're trying to watch those events very closely. The other thing that I would say that's starting to come into the fold is sort of this antitrust and regulatory environment, especially related to tech companies. So given some of that market leadership and given how much that's influenced returns, I think that's something to watch very closely. And then the third thing, it's a little bit of a micro element, but I think it's really important, and that's what's happening with insurance costs. So if we think about consumers and housing and how that influences the overall economic activity in our economy, it's all being driven by how much extra discretionary income consumers have. And so if you're in a coastal area or if you're in California, there are even situations where you can't get insurance. And that's a huge component of a consumer's spend. So I'm a little bit concerned about what I see there. And I think that, could be something that bleeds up into some of the higher income cohorts that we watch. But those are kind of the three that are on my radar now. I'll stress too, I don't see any major systemic risks. So the financial system is very solid. The regulatory environment there, has been, I think, worked out. It's been good. It's been healthy in a lot of ways. So we don't see any major leverage or risk there. And so I think systemic risks are probably at a very low point.
Great. Those are all very, very good points. Thank you. Thank you all for joining us. A brief survey will pop up shortly in your console, so please share your feedback and suggestions on future topics. A replay of this session will also be available within 24 hours, and you will receive an email letting you know how to access it. We wish everyone a wonderful day and a very happy Halloween. Thank you.
Thanks, everyone.